Good morning, everyone. My name is Johann Els. I'm here to take you through some of the budget highlights and what that means for the economy. Welcome. And as we go along through the presentation, you can type your questions in the chat box, and I'll try and answer them as soon as they come up, or at the end when we can have a Q&A session. But your questions and your discussion points and even disagreements are very welcome indeed. So the headline is that it was a good budget. It wasn't perfect, but it's following on the better news that we've had recently in terms of the fiscal situation in South Africa. So definitely a market-friendly budget, which adds in to some of the other positive news that we've seen in South Africa over the last couple of years. So let's first check the backdrop to the budget, the background, because that's important as well. Some of the impacts that came through from the global side impacted the budget and is also helping the rand to be fairly stable. So the global economy, yes, certainly there's more risks, which probably means increased volatility in markets. Growth is slowing down a little bit in the global economy, but global growth is still going to be ahead of what we've had before COVID even. So it's still fairly strong growth that we see rolling over from last year. But of course, the biggest global question is inflation. And we'll talk about South African inflation a little bit later on, but our inflation situation is somewhat different. In the global economy, very high inflation numbers recently has certainly led to significantly more hawkish messages from central banks. So the Fed turning hawkish, and we expect now interest rate hikes to come through fairly soon. Very tight monetary policy starting. The messaging is already there. That means significant risk. At a time when I believe inflation will be rolling over in the global economy, especially in the US, so slowing inflation, somewhat weaker growth from last year at least, and the Fed turning significantly more hawkish. That creates risks, and markets are certainly going to focus on the potential for recession in the USA. So it's certainly policy risk, one of the biggest potential market impacting forces over the short term. So expect more volatility on that front. But if you look at the numbers, still a very strong economic growth. This presentation will be available for download a little bit later on this site. So I'm not going to go through all the nitty-gritty number detail, but you can see in the column under 2022 that that's still strong growth, above trend growth before COVID even. Yes, it's down from last year, and that's the downtrend that I've seen recently in terms of some of the economic indicators. But we're here to talk about the SA economy. Yes, the global economy will still support us. There's still lots of support in terms of commodity prices as well, and we'll come back to that in a second. But supportive global environment, except of course for what's happening in Ukraine at the moment with the Russian invasion that seems to have started. But there's already been a hefty premium built into the oil price for some time because of that situation. It's already energy prices impacting on us. However, in South Africa, growth will be slower this year compared to last year, but growth is still on an upward path. Again, we'll come back to the medium-term outlook. Growth better this year than what we've had before the COVID crisis. So decent growth, supported by the global economy, still supported by the recovery that we've seen since COVID. A much improved fiscal situation, and that's the reason why we're here in this presentation. So we will talk a lot more about the budget and the improved fiscal environment. Inflation in South Africa also boosted a little bit by petrol prices, but there is no second round impact coming through. There's no demand push inflation. Inflation expectations is well anchored, so the interest rate cycle should be very moderate. Yes, some of those interest rate increases pulled into the first half of this year, but by the end of next year, interest rates will still be lower than what we started off before the COVID crisis. Growth, 2.3% this year. That compares to the 1% annual average we've had in the 5 years until 2019. So decent. Inflation higher this year because of the petrol price push, but still back to 4.5% again next year, back towards that target by the end of this year. Moderate interest rate upcycle, as I said. Budget good. Ratings has certainly troughed, so negative ratings action is behind us. And the rand stable. Yes, the hawkish Fed had an impact, but then the ECB turned hawkish at the same time. So the impact on the dollar has been fairly limited. And then still good commodity prices, improving local fundamentals, all have helped. And the rand really has been remarkably stable for good reason thus far this year. As an indication of my expectation for stable rand to continue, I've got 14.90, and I know the number will be incorrect, but that's an indication of where I think the rand will remain roughly this year. So stable rand this year, stable rand into next year. So we've had some positive surprises recently in terms of better growth numbers at the start of this year, in terms of the more optimism we've had. COVID really is still with us, but I think in terms of economic impact, it's behind us. So the bulk of the negative impact of COVID is behind us. We've had no further lockdowns during the Omicron wave, and that is very positive. And to some extent, that's starting to creep into consumer and business sentiment. And driving the highways of Cape Town, traffic is even more hectic than before COVID. So the economy is certainly starting to pump again. When I say pump, of course, relative to the impact that we had the year before last, 2020. But certainly it seems that it's even, traffic is back to 2019 type levels and maybe even worse. People are willing to get out there. And that's important in terms of businesses and consumers. I want to touch on briefly on the SONA message in the President's State of the Nation address. And the one thing that stood out for me is how he certainly pulled the private sector right to the center of things in South Africa. Now, since the President started his first term of office in 2018, he was always focusing on the private sector and the involvement of the private sector in the economy. Minister Tito Mboweni has done the same. Minister Godongwana is doing the same. But in that State of the Nation statement, the President saying that the private sector creates jobs, government doesn't create jobs. Government must just create the right environment for the private sector to prosper, profitably creating those jobs. And of course, that is important. It focuses the mind towards the policy reform that's needed in terms of getting economic growth through, and then getting the private sector to be profitable and be willing to create those jobs. That in an ANC election year is hugely important, and I think that sends the right message. And yes, we're always critical. We say if messages in the State of the Nation don't get implemented. My feeling is that the messaging is very strong, the messaging is very clear. Even if implementation takes some time, it's positive, the trend that we're moving into. The President feeling more confident about his ability to pull his colleagues with him. And I think we'll see more and perhaps faster policy change going forward. So we are here to talk about the budget. Certainly a significant improvement in fiscal fundamentals, and I hope that becomes clear over the next few slides. But in this budget, I labeled it as boring, but that is a good thing. There were no surprises, and everybody expected a fairly good budget, and that's relative to the MTBPS of November last year. That strong emphasis on fiscal consolidation, that continued. That focus on getting the budget towards a primary surplus, and that was pulled forward 1 year earlier. Now, of course, just as an aside, primary surplus is the budget balance excluding interest payments. So the rest of the budget must be in the surplus, and that makes it easier in terms of this fiscal consolidation path. We're also seeing an earlier stabilization in the debt ratio. Got a graph later on that's remarkable in terms of how that debt ratio has improved significantly over the last few years. There were tax giveaways, which was positive. The lower company tax rate, which some people thought might be cut in terms of not going ahead with that, that was still in there. No extra money for SOEs. No significant extra money, and really tough love for the SOEs. Overall, I think that was a very market-friendly budget in terms of good for equities in terms of the tax giveaways and the positiveness around it's not that contractionary. Yes, it's perhaps contraction in terms of public sector wages, but some tax giveaways better than expected. Good for bonds. Yes, some people say the issuance isn't coming off, but in terms of the overall fiscal stance, lower deficits, primary surplus fairly soon, stabilization of the debt ratio, no further negative ratings action thanks to this budget. I think that's good for bonds as well. So a market-friendly budget. And certainly ratings agencies will likely see it in that light, and we should expect no further negative ratings actions. So continuing on that path of the positive news, we've seen the budget deficit ratio being reduced over the medium-term expenditure framework, heading towards 4.2% in 2 years' time. 1 year earlier on the primary surplus, the earlier and lower stabilization of the debt ratio, and I think it can even turn out below that. Now, expenditure control is a big issue over the past few years. You might recall last year, Treasury significantly cut the medium-term plans for expenditure. This time around, yeah, they're sticking to those, but there's some room created by the extra tax revenue for some extra spending. And maybe that's one potential negative. Spending is a big risk in this budget, if we were to talk about risks, but there's also the using of some of the extra tax revenues in terms of easing on some of those expenditure plans. So maybe there's a slight negative there. We'll have to wait for the evidence. They're still focusing on that wage bill reduction. It might be difficult. Last night at the budget dinner, which I attended virtually, the minister was asked the question, what are you going to do if unions don't agree with your plans on the wage bill? The minister said, well, then we'll have to fire people. We're not going to raise taxes. We're not going to raise the budget deficit to finance further wage increases for the public sector. He was very adamant about that. Tax relief is positive, and no tax increases planned over the medium-term framework the next 3 years. The corporate tax rate is still going to go down from 28 to 27%. And some of the statements, and that's important because following on the MTBPS in November last year, lots of statements that the minister made, and again in the budget dinner last night, the same kind of sentiment that the president presented in Sona. And I do want to stress that there's very many positive sentiments. Yes, I accept that not all of that is implemented, but there's certainly been a trend change. And while implementation is still slow, at least some of these things are being implemented. And if the president and the minister of finance is on the same page regarding the needs, for instance, the structural changes that the economy needs, the revenue performance that they realize is not thanks to a better economy. We still need to fix the economy. The revenue performance came from commodity prices, so we cannot take it for granted that it will continue. So no permanent increase in revenue. Emphasis that the SOEs can't be bailed out anymore. They need to be fixed. And last night at the budget, and I'll keep on coming back to that, but the minister's own words in a public forum that then we have to get rid of them. He didn't say privatization. He said rationalize them, restructure them. But he said clearly if they can't run their business, then we need to get rid of them. A policy reform that needs to be accelerated. So lots of these messaging coming through, certainly sending the message not only to the public, not only to the investors in the business sector, but perhaps to his own colleagues as well. And this is perhaps if I were to show only one slide today, this would be the slide. It shows the progression of the debt to GDP ratio. Now, this is admittedly a very short-term period. Debt ratio used to be very low, below 30%. Back in 2008, before the global financial crisis started, moved up rapidly in the ensuing years when we couldn't get the budget under control. And of course, the economy grew at a much slower pace. And then the COVID crisis hit hard. So you can see the blue line at the top, which was the anticipated ratio, debt to GDP ratio in the October 2020 budget, peaking around 95% to GDP. We've seen a significant improvement to February last year, and then of course a drop down when GDP numbers were revised upwards in September last year. But even since then, the November 2021 MTBPS, the grey line there, even from then to now is a further reduction in that. My own line is the green line at the bottom, with slightly better growth than Treasury's forecasts. And I do think that their forecasts are too conservative. We can see even lower. So debt to GDP ratio that will peak likely pretty soon and then start easing off. Of course, we need sustained higher economic growth to make a serious downtrend in that possible. For now, that's not likely. I do expect better medium-term growth, and that's built into my green line there. But certainly, this is a picture that ratings agencies will like, and we've already seen post November MTBPS Fitch adjusting their outlook from negative to stable, and I think we can see more of that. So the point very clearly, the minimum expectation was for this budget to not be worse than November MTBPS. It was even slightly better than the November MTBPS. So very positive. In terms of the tax windfall, and we'll go into the detail that they're using for lower deficit, debt repayment, but also to finance some of the tax increases and a little bit of extra spending. Primary surplus now pulled forward 1 year. That is positive. It's admittedly only a very slight surplus, so we need further emphasis there. But I think there's conservative budgeting, and we can perhaps get there earlier and a bigger primary surplus. And the focus continues to be very strong in terms of all of these. Just a brief look at where we've come from. In the October 2020 MTBPS, the budget deficit for the 2020-21 fiscal year was estimated to be 15.7%. We're now down to 6%. That is a huge, significant improvement. And yes, some of that was windfall taxes that might not be repeated, but it does make an impact. So certainly a huge improvement in the fiscal situation. So in terms of, if we start to look forward from the current fiscal year, we've had significant revenue growth. You can see in the table there, 22.4% growth in revenues into the current fiscal year, which only ends at the end of March versus the previous one. That cannot continue. And certainly in terms of expectations for commodity prices, mining taxes cannot continue to run that hard. Other taxes have run hard. They cannot continue at the same pace. So Treasury forecasting their 2.9% growth in revenue. I think that's very conservative in terms of their assumptions. Low expenditure growth as well compared to last year. So there clearly is risk on the expenditure side. So from a minus 5.7% deficit in the current fiscal year, a slightly higher deficit budgeted for next year. So yeah, doesn't continue too fast, but the assumptions for the 2022-23 fiscal year is very conservative. We would probably end up better than that. But the medium-term forecast is still for the budget deficit to reduce quite a bit. Pat asked a question on the chat box about wage cuts. I don't think it's wage cuts necessarily, but relatively flat wages going forward. Yes, that's investor friendly, but yeah, that is certainly a risk in terms of the expenditure going forward. Yeah, frontline workers, teachers, health workers, etc. But without having knowledge of a specific salary levels within those frontline sectors, overall public sector wages have risen significantly above inflation over the last 5 to 7 years. Significant more than what happened in the private sector. And in many areas, the public sector salary levels are above what you have in the private sector. Unfortunately, those excess wage increases that we've seen over the last few years in the public sector has blown the budget deficit significantly out of the water. So we need to see some correction there. And it probably needs to be not only in the frontline workers, but also in other sectors within the public sector as well. So there needs to be a shakeout, whether that's just wage increases or jobs, which is very difficult, but a bloated public service with too high wage increases have put us in the situation that we're in. So yes, it's not an easy answer. So if we look at Treasury's forecasts versus my own forecasts, a table on the left, especially let's look at the GDP numbers. You can look at the other numbers in your own time once you've downloaded the presentation. I expect 2.3% growth for this year. Treasury is relatively close with 2.1. And I've got 2.5% next year because I believe that there's lots in the pipeline in terms of the expectations for growth, especially private sector fixed investment, especially in the energy sector, that can lead the fixed investment cycle, where I've got 6% growth next year. So 2.5% growth next year versus Treasury is only 1.6. Where I think there's a big difference that comes through in terms of the growth of nominal GDP going forward. The table on the right, where Treasury forecasts GDP inflation of only 1.5%. That almost all economists agree is far too low. Now, of course, within GDP inflation, there would be export price inflation. Within that would be commodity prices. So they're very conservative in terms of their assumptions for commodity prices. And yes, I would rather have them being conservative, but I think they're too conservative. So their nominal GDP growth number for this year is only 3.6%, where it can easily be above 5%, 5% or above. Whether you believe my forecast for GDP growth or not, I think the inflation assumption is too low compared to other inflation numbers. Dieter, will the minister be able to implement the changes he wants to make and get the support required? Dieter, yeah, I've seen, I hear what you're saying in terms of lots of talk and little action. I think we've seen more action recently. We've certainly seen some of the evidence of the talk coming through into the numbers. Yes, the economy has helped. Yes, commodity prices have helped. But the underlying picture in terms of expenditure control over the last few years, they've shown that in terms of the wage increases, where they didn't in 2020 give any increases, and last year as well, when they only had the cash gratuity. So they are following through. And yes, it's perhaps still a valid question, difficult to turn into action. But I think the confidence that the president is displaying in his State of the Nation address in an ANC election year shows that he's serious about this. The willingness of the Minister of Finance to last night at the budget dinner make public statements to this effect, I think shows that they're more confident in their ability to convince their colleagues. So I've certainly seen a trend change in this, and I certainly believe that at least they will try their utmost best to implement what they're saying. I know it might not all be happening, but at least the trend is our friend at the moment. So again, good budget because of the consolidation commitment. Yes, the tax relief will be welcome for the economy. Fact that it's market friendly for equities and bonds, the fact that ratings have troughed, all of that makes it friendly. So the revenue overrun used for productively to reduce the deficit and the fiscal and the debt ratios. Again, the wage bill targets, that's important in terms of going forward, but that creates a risk. As you said, Dieter, as you said, Pat, there are risks around that. So using some of the tax windfall for tax reductions, that also helps the consumers, and that makes it a feel-good budget. So this commitment that they've continued to show is hugely important. On the negative side, certainly there's spending risks. We've talked about the wage bill, the fact that they've got very low growth numbers included into the budget for the wage bill, the fact that they've got very low growth numbers included in the social grants line from next year onwards. They don't show a continuation in the COVID grant beyond March 2023. So that creates risks. If the COVID grant continues, if the unions demand higher wage increases, there's risk for the budget. Although the minister said last night, then departmental budgets will have to cut elsewhere to finance wage increases. So there's a very strong statement of intent. And yes, I agree with the sentiment that there are risks around that, certainly. The primary balance, the surplus that they're forecasting in a year's time, that's very small. So there's risk around that. But coming back to the conservative budgeting in terms of GDP numbers, in terms of growth numbers, in terms of very low assumptions for revenue numbers going forward. And there were no new economic policy reform measures announced. So there's execution risk. I totally agree with that sentiment. And low expenditure growth, so perhaps not that good for the economy. If you exclude interest rates, social grants, and the wage bill, expenditure growth of only 2.5% per year over the next 3 years. That's very low indeed. So firstly, a risk, but also a contractionary budget that's not pumping money into the economy. But that's good. That's what we need at this point in time. So I would urge them to try and stick to that. We can't afford for the fiscal side now to stimulate the economy unnecessarily. Interest bill is still crowding out other expenditure. Interest bill is growing by 10.4% per year versus the rest that's growing at very low, below inflation numbers. Yes, there were some small amounts given to Sasria and Denel, nothing extra for Eskom. In the budget, of course, there's still that 22 billion per year that's going to Eskom that was announced some time ago. And there's also no new news on Eskom's debt, although the minister made some comments that they're advancing the conversation around that. If Eskom sticks to their target of breaking up by the end of this year, then there needs to be some kind of issue resolve of the debt issue. Treasury also says they want a more robust fiscal anchor to anchor spending, to get the budget deficit under control, to put in place measures through legislation perhaps, to get a primary surplus going forward. And that's positive. They say they're not happy with the expenditure ceiling as that anchor anymore. So if we look at the expenditure position, this same table last year showed significant cuts in spending over the medium term. The wage bill cuts, the other cuts through different departments. This time around, and I've seen some negative comments around this, they are using some of the tax windfall to finance expenditure. So expenditure over the medium term is increasing. That's the main headline here. So no increases in wage bill, but some others that's been held back perhaps. And you can see through the table, it's from education, from health department, and the social welfare spending, of course. So it's a positive budget from that point. And they made a big thing about the social wage, which is all the social grants, the transfer payments to households versus the health spending, education spending, that's all coming under their so-called social wage. Sydney asks, is the commodity super cycle party over? Yes, it's been a savior. Don't know if it was a super cycle. It was a pretty short cycle. We've seen that decline in the commodity price index of the commodities that South Africa exports, which is gold, the PGM grouping, coal and iron ore. That has recovered after that slowdown in the second half of last year. It's recovered again earlier this year. I think in terms of the global situation, China's growth target probably going to be set around 5 to 5.5% growth, which is better than expected. Still decent growth elsewhere in the world. I think there's enough support in the global economy for commodity prices to hang on in a band around these type of levels that we've seen recently, which is significantly above where they were before this cycle, this upcycle started. There's not enough to lift it, to keep it at the high levels, but there's enough to have in the band. So the commodity cycle isn't over. Yeah, I don't think there's a super cycle. That's my opinion. I think there's still support for the mining sector. I think there's still support for some of those tax increases to come through. Certainly not a super cycle, but enough in the global economy to keep commodity prices relatively stable. Just a brief note on BIC, basic income grant. To some extent, the debate has turned a little bit because of the extension of the COVID grant. I don't think we're ever going to get the basic income grant in that true form as it was intended. I think we might see a continuation permanently of a COVID type grant, an unemployment type grant, not the full big, because we can't afford the full basic income grant. And maybe there's some room here for negotiation. You might recall that the president said in the State of the Nation address, part of these policy reforms, he wants a new social compact between government, business, and labor in the next 100 days. Maybe there's room for negotiation here, a quid pro quo in terms of Treasury government saying to unions, you know, in exchange for continuation of a COVID type grant beyond March 2023, we want to do these economic reforms. So part of that could be coming out soon. So I think there's room for that type of negotiation, and we certainly need that faster policy reform, and maybe there's a negotiation to be had there. Dita asked, are there any lobbying with Treasury to change the 350,000 pension deduction interest-free? I don't know, Dita. I don't know whether that's happening, or the donation allowance. I don't know if there's anything there. I'm pretty sure that the industry is always talking to Treasury about these things, but whether there's a significant lobby behind that, I'm not aware. So I don't think a basic income grant is ever going to happen. Oh, one last point about the COVID grant. I think it's politically advantageous to government to keep on rolling this over. It's new news every time that they say, okay, we're extending this. Okay, we're extending this. If you make it a once-off permanent extension, then there's only one round of news, positive news in that. So I expect them to keep on rolling this down the line. So some of the revenue highlights in the current fiscal year, 201 billion rand extra revenue compared to what they budgeted in February last year. And another 62 billion on their already adjusted budgets in November last year. So significant revenue overrun coming through. I'm surprised that they accounted for all of this. Had they accounted for less than 200 billion, let's say 150 billion, they would have shown a bigger deficit this year, and they could have shown a decline in the deficit from this year into next year, instead of now showing a slight uplift in the deficit. And then eventually, when the final numbers came out, they could have accounted for this. So I was slightly surprised here, because it's politically also, but I suppose they eased that argument by giving away some of the tax take for tax cuts this year. But still, I was surprised that they did that. Nevertheless, it's a very good performance. It wasn't only mining taxes due to commodity prices. It was perhaps conservative budgeting, but the economy also rebounding stronger in last year than what they expected. And as I said, they're using this productively. And then tax relief, we can argue about the 18.7, but it's what they gave away in terms of not adjusting this. If they hadn't adjusted the tax scales, if they didn't, or if they had raised the fuel levy, etc., it's 18.7 billion that we wouldn't have seen. So they're also not hiking taxes over the medium term. And the positive revenue numbers are now flowing into the next few years. Oh, slightly better economic growth, but also the base is better. So extra revenue over the next few years, which to some extent is going into that spending, extra spending that we saw on that other graph. But overall, very positive. So as you know by now, the tax bracket is adjusted. So that helps certainly consumers. There's no fuel levy increase, the first time since 1990. Last year, there was a 15 cents a litre increase. No RAF increase compared to last year. And excise duties, or the sin taxes on alcohol and tobacco, is also lower than last year. They talked a lot about the progress at SARS. So those of you who are old enough, like me, will remember back in the early 2000s when SARS was doing so good in terms of tax collections that every year there was a line in the budget, in the revenue budget, for better tax getting in by SARS because of the capacity. I can see that happening pretty soon, where they start to enter a number in the revenue budgets for better collection, improvement at SARS. So that is certainly very positive. If you look at the revenue targets for the next year, you can see there the better revenue numbers in some of the main tax components in 21-22. You can see, for instance, that 105 billion more than expected just in corporate income tax, the bulk of that mining taxes. But for this year, they expect a decline in the corporate income tax line, 15.2% decline. That's very conservative. Might come out better than that. I think still negative, but not minus 50. Very low increase in the personal income tax line. And I think we're seeing some employment. Employment growth is slow, but it's positive. VAT improvement there, fuel levy decline. If I look at Cape Town's highways, it took me 2 hours on Tuesday morning, 6 o'clock in the morning, 2 hours from Stellenbosch to Cape Town. Highways are blocked. I think that fuel levy, and yes, they, of course, now because they haven't raised the fuel levy, but I think people are back on the roads. So conservative budgeting for the revenue components for the new year. Conservative budgeting is good. Conservative budgeting on the revenue side, conservative budgeting in terms of the nominal GDP in inflation number or the nominal GDP growth. All of that says to me the budget might eventually come out better than expected. In terms of the tax numbers, again, the table is in the pack that you can download. 76% of the income tax relief in terms of adjusting the tax brackets accruing to taxpayers earning less than 750,000 per year. So that's quite hefty. But even the top guys are getting some relief. But the point about this slide is that still that 71% of all income taxes are paid by those earning more than 500,000 per year. So some of the reason why they can't tax the rich more, because they can vote by their feet by leaving. Easier for the rich to do something to limit their tax bill. So the bulk of income taxes paid by the rich, but you can see the breakdown there. 29% of all income taxes paid by those earning more than 1.5 million per year. So I suppose in a society like South Africa, there's nothing wrong with it, but in a society like South Africa, also the rich can leave. So you don't want to tax them more. Those are our tax realities. The bottom line in terms of the budget, it's a good news budget. It's market friendly in terms of equities, market friendly in terms of bonds. Some of that might only come through a bit later, but I think building on what we've seen thus far in terms of politics, in terms of policy, in terms of somewhat better growth numbers early this year, that's a confidence booster. Also because we don't expect any more ratings, negative ratings action. So the strong commitment to fiscal consolidation continues. Yes, it's always a situation of give and take, extra COVID grant, extra spending here and there, and there's always execution risk. But I think under the circumstances with South Africa's growth situation, this is a very good budget. Let's just recap, and to many of you, I've many times before talked about the better medium-term outlook and getting a turn in that downtrend in economic growth from the downtrend we've had. And as I said earlier, the annual average growth in the 5 years to 2019, in other words, before the COVID crisis hit, was just 1%. That's virtually nothing. Then we had the COVID negative growth year in 2020, the COVID rebound in 2021. Now, where are we heading over the medium term? I said earlier, this year I expect 2.3%. My expectation is that over the medium term, we'll have 2.5% GDP growth. Now, again, 2.5% isn't enough. It's not great, but it's more than double the 1% we had. That will start bringing some confidence back for consumers. That will start bringing some confidence back for business. That will start bringing some confidence back to the investor community, because it improves not only growth, it improves the fiscal situation even further. It creates an environment where foreign investors will be willing to invest again in South Africa. So in an emerging market like South Africa, risks are certainly higher, but you need to give investors that growth. If you've got risk but no growth, they won't invest here. They'll go to other emerging markets where there's risk but also higher growth. So we need the higher growth. But ratings agencies will be happy with things in South Africa, and I expect that ratings agencies will improve our outlook. I went the wrong way there. Just in terms of the outlook, and not all of these things are positive, but it's the trend change from lots of negatives in terms of policy, politics, yes, even load shedding, to some of those headwinds dying down a little bit, and some of them starting to have some tailwinds. The political environment is far better. The president is going to more easily get into a second term as ANC president. He hasn't got the Ace Magashulas of the world behind him that keeps him back. The policy environment has improved significantly. The spurt of policy action in the second quarter of last year. For instance, the 100 megawatt self-generation limit, where he went over the head of the Minister Gwede Montash. The private sector involvement in the ports, in Transnet. Yes, in the second half of last year, when the July unrests and the ANC's bad showing in the local government elections caused many investors to think that the ANC will shift policy towards the left. That didn't happen in the MTBPS in November last year. Certainly, the president in the State of the Nation address pulled policy right towards the center. Instead of jumping to the left, bringing policy to the center with his stated conviction that government doesn't create jobs, government creates the conditions for the private sector to create the jobs. That's significant. That's more significant than we perhaps realize. It's not a jump to the left, policy right back in the center. And that's a big change. Yes, we've still got load shedding, but we're a couple of years advanced in terms of the private sector's involvement in the energy sector. The self-generation lift in the limit, significant private sector investment in the energy sector coming through, the Eskom's maintenance program, etc. We've moved a long way. Certainly the risk, we talk about medium term, 1 year down the line, 2 years down the line of load shedding significantly reduced than 2 years ago. So it's the trend that's important, from lots of negatives in the Zuma years, less negatives, slight positive starting up, and some of these tailwinds actually gaining some speed over the next few years. So things are improving, and it's that trend that's important. And that is important in terms of the currency. On the left-hand graph, I've got the South African export commodity price index, what we export. You can see the one line is only platinum included, the bottom one. The top one has got the full PGM basket, and there rhodium is, of course, the important one. The point about both of those graphs are that commodity prices at present are far higher than what they were in 2016, even higher than 2014. And after that slowdown in the second half of last year, we've seen a rebound again this year. So people are asking, why is the rand so strong? It doesn't make sense. It makes absolute sense. There was a limit on the dollar strength because when the Fed turned hawkish, the ECB, European Central Bank, turned hawkish at the same time. So the dollar didn't advance any further. Locally, we've got the benefit of commodity prices, but we've also got the benefit, think back to the debt to GDP ratio graph, significant improvement of the fiscal situation, significant reduction in fiscal risk, better political policy growth environment. That's all reflected in the currency. And as I said earlier, as an indication of my expectation that the rand will remain stable, I think I said 14.90 for the currency by the end of this year. By the end of next year, I say 15.25. That to me is still a stable currency. If you look at versus PPP, purchasing power parity, which inflation differentials, and I use PPI inflation, producer price inflation, between us and the USA. The fair value on that blue line is 10.93. Now, the rand is a bit away from that. I'm not exactly saying the currency will go to the blue line, but it can move closer to the blue line if things keep on improving. And I think that's important as well. Sean asks, what economic impact could we see if SA can combat money laundering, terrorism financing, international standards? Yeah, that's important, Sean, very important. But I don't know that that will be any short-term impact. It's one of those things that is part of everything that we do, needs to be correct, needs to be seen as international best practice. So I don't think that on its own will be a huge economic impact. But if we're seen to be on par with the rest of the world in terms of money laundering, if we seem to be having a great financial system, financial sector, if we seem to be fighting corruption in total, if we seem to do the right policies, if we fight fiscal risk, all of these things, all bundled together, that will be a positive. I don't think one thing on its own will be enough. So in terms of this graph, of course, it's one of the nicest graphs for an economist to go through. I haven't got the time now. I think the rand can be stable. The rand can strengthen a little bit, but best we can foresee for now is stable. But at least it shows us that the momentum in the blue line, the underlying fundamentals of the currency has also stabilized recently. That will help the market determine rate. Let's briefly look at some of other economic indicators, but mostly I'll leave that for you to look at later. Just some slowing in the global growth situation that I mentioned earlier. The Fed's hawkish tilt means interest rate increases will start. There's a risk of 50 basis point increments. I don't think they'll go there. That'll look scary. That'll look to the market as if the Fed is scared. I still think inflation in the USA will come off, but the Fed might actually start quantitative tightening, pulling back the size of their balance sheet. In other words, the opposite of quantitative easing. I think there's policy risk there, as I said at the start. Our own numbers for the fourth quarter not looking great, but the fourth quarter will still be better than the third quarter. Last year's growth probably around 4.7%. Recently, we've seen a tick up in the PMIs in South Africa, whole economy PMI, manufacturing PMI, expected manufacturing PMI, also the leading indicator ticking up. All of that's positive. So economic growth really started on a good footing in the early part of this year. Even car sales, graph on the left, the purple line is seasonally adjusted car sales in January. That was up 12% month on month. So consumers having some confidence in the future. And I stress seasonally adjusted because it's not those people wanting a car registered in a new year, the 2020 label on it. It's seasonally adjusted. So that takes into account last year as well. Inflation, boosted by petrol prices, but underlying inflation, excluding petrol, only 4.3%. There's no evidence of second round impact, no evidence of demand push inflation. And the new weightings, new rebasing, some moderate downward impact, and inflation expectations quite well anchored. So moderate interest rate increases going forward. I think let me stop there. If you've got questions about forecasts, the presentation is available for download on this website. Let's go into question time. I'll take some of the questions that comes through on the chat box. I have got a moderator, so if there's repeats, he's getting the repeats out of that for me and passing on some of the other questions to me. But you're also welcome to unmute yourself and talk to me. Thank you. Sydney asks, is the NDP in back burner? I don't think so. In terms of talking about it, perhaps National Development Plan, Sydney, you're talking about, they're implementing many of the things that was in the NDP. From time to time in the budget documents, we do get mention of the NDP saying, as the NDP indicated, we want to do this or we want to do that. But certainly you're correct in terms of the sentiment in your question. There's no strong impetus. There's no strong saying, NDP, we must implement this. That's part of that we could potentially have economic growth lifting higher than my 2.5% growth forecast. So maybe it's slightly on the back burner, but I do see some mention of some of the stuff that's in the NDP that comes through in terms of the policy announcements that we see. Any further questions? As I said, you're also welcome to shout out. Is there anything that I didn't talk about that you want to talk about? So in the forecast section on the pack, I explain why inflation forecast is perhaps higher in the first few months of this year, but then easing off again towards the end of the year. So that means interest rate increases perhaps front-loaded into the first half of this year, but still interest rates by the end of next year still below what we had in February 2020. In other words, before we started the emergency rate cuts for the COVID cycle. In summary, a good budget, a significant reduction in fiscal risk over the last few years. Better political and policy environment means medium-term growth should lift. We've seen a trend change from a downtrend to stabilization to a slight uptrend, even in ratings. I expect Moody's to, in their next review, to change their outlook statement from negative to stable as well. So while it still will take some time before we see increases in credit ratings, or even longer before we see investment grade ratings, we've bottomed in terms of the down cycle. So certainly an improving environment, and all of that is behind the currency. So I expect continued pressure on government in terms of spending, but them trying to resist those pressures. I think let's end off there. Thank you all very much for joining. And again, you're welcome to contact me via email if you've got further questions or suggestions. And of course, disagreements always welcome. Thank you very much. Have a great day. Bye-bye.